There's over 6,000 stocks listed on the major US stock exchanges. There's also over 2,000 ETFs and countless mutual funds, bond funds, real estate investment trusts, cryptocurrencies, and on and on and on. Sometimes knowing where to put your money and how much to allocate to each different investment can be a little bit overwhelming. But what if I told you that a single ETF or exchange traded fund is all that you need to have a solid balanced portfolio with a good return on investment that can eventually lead to your retirement? Well, it's true, and in this video I'm going to break down the 4 best ETFs in the US if you're looking for a simple one fund portfolio with just one ETF that you can continue to put money into whenever you have spare cash and eventually retire off of that. So let's jump in with the first ETF on the list, which is going to be the Vanguard Total World Stock ETF, or ticker symbol VT. Now we're starting pretty wide here in that this ETF tracks the entire global stock market, but I'm going to narrow it down a little bit by the time we get to the last ETF on the list. Also, for each and every option here, I'm going to discuss the pros and the cons. But first of all, what is VT? Well, like I said, this is a single ETF that tracks the entire global stock market, both developed and developing markets. Its main holdings are in North America with almost 63%. So that's the US and Canada, but then they've also got investments in Europe, the Pacific region, and also about 10% of the portfolio is in emerging markets. This is a very big ETF with net assets under management of $35 billion and over 9,000 companies listed within it. So that means every time you buy one share of VT, you're buying a tiny fractional amount of over 9,300 companies all around the world. The expense ratio for this ETF is 0.08, so very reasonable. Also, there's a dividend that hovers around 2% per year. And if we look at the performance of this ETF over time, you can see that it's had a very solid return on investment. Since inception, it's returning an average of 8% per year, although in the past couple of years, it's been well above that. Now, in terms of some of the pros of investing in this ETF as a one fund portfolio, first of all, it's the most diversified of any of the options out there because you're investing in over 9,000 companies worldwide. So pretty much any company in the world that's worth owning, you're buying a small part of when you invest through this ETF. And with that diversification, you're getting exposure to markets worldwide, which decreases your risk in one sense because let's say that there's a massive recession that hits the US really hard, but that doesn't hit Asian markets or it doesn't hit the European markets as hard. Since you have exposure to different global markets, then you're hedged against that kind of risk. On the con side though, there's another type of risk that comes with this ETF, which is that since you're investing in emerging markets, for example, China or India, some of those markets aren't as well established as the US stock market, so there could be more volatility. Overall though, this is a great investment to hold in a one fund portfolio because it's so widely diversified and you'll probably see solid growth in your capital over time. Okay, next up is another Vanguard ETF, but we're narrowing it down a little bit to just focus on the US market. So the Vanguard Total Stock Market ETF, or ticker symbol VTI, does just that. As you might have guessed from the name, this ETF tracks the total US stock market. So you're investing in over 4,000 companies listed on US stock exchanges when you purchase shares of this ETF. This is a massive ETF with net assets under management of $1.4 trillion. This ETF has an expense ratio of 0.03%, so it's 0.05 less than VT, but it has a slightly lower dividend yield of around 1.3%. And if we look at the performance of VTI, you can see that since inception, it's yielded a 9% per year ROI, and over the past couple of years, it's been 25+%, which is honestly huge. Now, in terms of the pros of VTI, first of all, since it tracks the US total stock market only, you know that you're investing in some of the largest and most well-established companies worldwide. And historically speaking, the US market has returned some of the safest and most stable returns on investment over time. And that's why a lot of ETFs put most of their money in the US market. It's also pretty well diversified with over 4,000 companies held within this ETF, although definitely less diversified than the 9,000 companies held in VT. Also, the super low management fees is definitely a big plus. A final pro is that VTI has historically outperformed VT by about 1%, although past performance is not necessarily an indicator of what's going to happen moving forward. On the con side of the equation though, since you're only investing in the US market, if there was an event that hurt the US more than it hurt other economies worldwide, then your portfolio might underperform. That said, VTI is definitely still a solid possibility if you're looking for a one fund portfolio. Okay, moving now to number 3 on the list. I'm actually cheating a little bit here and I'm lumping 3 ETFs in one. And we're narrowing the search a little bit further here to ETFs that track the S&P 500 index exclusively. Now, the 3 ETFs that I'm talking about here are VOO, which is the Vanguard option. Then you've got the iShares option, which is ticker symbol IVV. And then you've got the SPY, which is actually the oldest ETF in the US and the first one that tracked the S&P 500 index. Now, all three of these ETFs are very similar in terms of what you get when you invest in it, because they're tracking the exact same index. So you're buying tiny fractional amounts of every company that's listed on the S&P 500. Now, there's minor differences in these ETFs in terms of the expense ratio. For example, VOO is a 0.03 expense ratio, whereas SPY is 0.0945, so it's slightly more expensive. But let's just look really quickly at VOO because it'll be consistent with the first two options on the list, which were also both Vanguard ETFs. The dividend yield for VOO is around 1.3%, so very similar to VTI. It's got almost $1 trillion, 850 billion under management, and you can see again the top 10 holdings are identical to the top 10 holdings of VTI, of course, because these are the 10 largest companies in the US. But what makes VOO different? Well, this ETF actually does not invest in small cap or mid cap companies. To be listed on the S&P 500, you have to meet certain thresholds, or a company has to meet certain thresholds of how large they are. And so this is only investing in the largest companies in the US. Now, when we're talking about pros and cons, let's first look at the performance of this ETF. And you can see that it's yielded 16.17% per year since inception. And the most recent few years have been well above that. So that's the obvious main pro of having an exclusive S&P 500 index investing strategy. On the con side though, there's much less diversification because you're only investing in 500 companies. Now, some would argue that investing in 500 of the world's largest and most well-established companies is better than investing in a mixture of mid-cap, small cap, and large caps. But like I mentioned previously, past performance is not necessarily an indicator of future results, and greater diversification is, generally speaking, a way to lower your risk, so less volatility. However, if you're confident that the US stock market is going to continue to outperform the global stock market, and that in particular, the 500 largest companies in the US are going to outperform all of the other companies, thousands of stocks that are listed on US stock exchanges, then this could be a very solid option. Now, for the fourth and final option, we're actually going a little bit narrower and increasing the risk reward calculation once more with the Invesco QQQ ETF, which goes by the ticker symbol QQQ. Now, this ETF tracks the 100 largest companies listed on the NASDAQ stock exchange minus financial companies. So it's basically all tech. For example, these are the 10 largest holdings within the QQQ, and you can see that most of them are tech companies. And if I scroll down here, you can see the sector allocation. 48.3% is information technology, but then you got communication services, consumer discretionary, and so on and so forth. Now, the management expense ratio for this ETF is 0.2, so it's higher than any of the other options that I've discussed here today. However, if we look at this ETF's performance since 2012, you can see that it's outperformed the S&P 500 index by a pretty considerable amount. Now, the dividend yield for this ETF is actually less than 0.5%, and that's because a lot of these major tech companies don't actually pay dividends. The main pro of this ETF is the potential return on investment because you're investing in a lot of high growth companies. On the con side though, there's a lack of diversification because you're only investing in 100 companies. The management fee is definitely higher, the dividend yield is lower, and there might be more risk or potential volatility because you're only investing in that 100 companies. And if the tech sector is getting crushed, for example, which it has been over the past couple of weeks, then this type of portfolio that's only investing in the QQQ would probably underperform a broader index. Now, a really important thing to mention here is that these are all equity ETFs. They're only invested in stocks and not in bonds or other fixed income investments. So what that means is I think these options are really good choices for people that aren't in retirement or close to retirement, because generally speaking, the recommendation is that as you get close to retirement, and certainly when you're in retirement, that you shift a pretty significant percentage of your portfolio towards things that generate income, so dividend income or interest income. And since all the ETFs that I discussed today are exclusively invested in stocks, they're probably more appropriate for people that are in their 20s, 30s, or 40s, which realistically is everybody watching this channel anyways. Because if you're not thinking about retiring anytime soon, then an all equity portfolio will probably have a much better return on investment over time. Anyways, I hope you enjoyed this video and found it useful. If you did like it, you might also enjoy this one or this one. Thanks so much for watching and have a spectacular day.